Today we're going to have conversations with Kyle. Kyle represents Fidelity Charitable side of the business, I guess is what you would call it, the Fidelity Charitable side, which focuses on donor advised funds amongst other assets. And let's just do a deep dive into what are donor advised funds. Let's start with that.
Good start, Amar, and thanks for having me here. So, really quickly about donor advised funds, what they help both clients, individuals, companies, entities do is separate the timing of their income tax deductions when they actually have to give the money to their favorite nonprofits. So, really short, donors take the tax deduction when they fund the account, the assets inside the account grow tax-free, and then they're really giving to their favorite nonprofits at their own pace, as much or as little as they want to year by year. They're basically allowing donors to establish and fund the account by making an irrevocable tax-deductible contribution to the charitable sponsor, and then the donor retains advisory privileges and may recommend grants from those funds to other charitable organizations.
And I know there's been a lot of changes over the years in the landscape of donor advised funds. I know there's community funds, there's these funds that are backed by financial institutions. Let's talk a little bit about that. Like, how has that changed over the years from what people may know to what's really going on today?
Yep. So community foundations have actually been around since the 1930s and 40s, operating donor advised funds and other sort of types of charitable giving vehicles. But really, donor advised funds became a lot popular in the early 2000s. Fidelity Charitable was started back in 1991. But as you mentioned, the big players in the donor advised fund space are ones that are backed by financial institutions, right? So of the top 10 U.S. charities in terms of size or annual contributions that they're taking in, 3 of those top 10 are donor advised funds. Fidelity being number 1, Schwab's program is usually 3rd or 4th. Vanguard has a program that's usually 7th or 8th. There's also a wide range of community foundations, whether those are religious-based or geographically affiliated. There are a lot of independent donor advised funds that operate on a national scale but are not affiliated with a financial firm. And now even big charities like the United Way and large universities are getting into the donor advised fund space. So right now there's probably pretty close to 1,000 donor advised fund sponsors that all offer differentiators based on their areas of expertise.
Yeah. So I guess what is a typical profile for somebody that's looking to put money in a donor advised fund? Like, are we talking companies? Are we talking individuals? How does that look?
Well, that's that look like? Yeah, and that's another thing that's changed a lot too. I mean, really, the donor, a lot of folks looked at it like, hey, I have to be giving a good amount of money to charity in order to make this work for me. But that's really evolved over the years, and you can see it by some of the data, right? So about, say, 5 years ago, the average account size of donor advised fund was over $250,000. Now it's a lot closer to 150,000, and we're seeing a lot of donors that are all over the map, right? We're seeing folks that are using it to fund maybe just a few $1,000s a year to their favorite charities, all the way to your Silicon Valley tech entrepreneurs that are giving away 8 or 9 figures a year, and then everything in between. And the idea of donor advised funds is really to democratize charitable giving, right? Where you're not looking at one profile or one individual, but naturally the rise of the equity market over the last 10, 12 years has prompted a lot of this growth. A lot of folks fund these accounts with appreciated securities because there's a double tax benefit for folks, right? So they don't have to pay capital gains on the growth of the asset, and they get a fair market value tax deduction based on the value of the stock when they put it in. So there's a lot of value for folks that are looking at their portfolios, have a lot of gains, and realize that, hey, maybe we don't want to sell this asset because I know it'll trigger a big capital gain event. They'll use those assets to fund philanthropy into vehicles like this.
Yeah. Yeah, and I think it's not just those big players that are looking to get rid of capital gains, but it's also retirees that may just do standard deductions and stuff like that. So maybe we can end on something more closely related to somebody that's, impacted by the Tax Act and Job Act of 2016, and they're just looking at their charitable giving, and now they can't deduct it. Like, there are strategies using a donor advised fund that can help with that, right?
Big time. I mean, our average donor age is about 62 and a half. So it goes to show you that a lot of folks use these accounts on the doorsteps of retirement, right? Where somebody's getting close to their, let's say their retirement years and says, hey, just like I've saved for a 401k during my working years, just like I put aside money in a 529 plan for college savings, I'll do the same with my charitable giving. And I can pre-fund my giving into this vehicle so that, hey, at the end of the day, when you're retired, you're not dipping into your own pocket to pay for charitable gifts. You mentioned it before, Amar. The Tax Cuts and Jobs Act of 2016 really changed the game. It eliminated a lot of popular deductions for folks, and it really kept three major ones: mortgage interest, charitable giving, and what's called state and local tax, or SALT. Right. So if, like you just mentioned, if you're a retiree, you don't have a mortgage, you're married filing jointly, you need to give away something in the neighborhood of $14,000 a year to charity, just to take the same tax deduction as if you didn't give away a penny. So that's where we saw the game change big time. And that's really where folks will pre-fund their giving. They'll put maybe 5 or 6 years worth of giving into their donor advised fund account, take that tax deduction that year, itemize their deductions at that time, and then take the standard deductions in future years. All the while they give to the same charities at the same pace they always have. So there's a lot of value there too.
Awesome. And just, some of your audio was going in and out here. So I'm just going to repeat what you said, in the sense of that using the donor advised fund to gift what you would give over 5-10 years and gift upfront into the donor advised fund allows you to maximize the ability to itemize and get a larger deduction up front, and then transition to standard deductions over a period of time. And that allows you to get the charitable deduction that you wouldn't have gotten if you were just doing standard deductions.
Right. And giving
and this is a big planning technique, especially for people that have, appreciated stock in retirement, and they want to reset their cost basis. They still like the stock, but what they'll do is they'll donate some into the donor advised fund and then repurchase that same stock with other dollars, so it gets a higher cost basis, and they don't have to pay the tax burden on that. It works when you're charitably inclined, and it's a good strategy. So, all right, Kyle, thank you for joining me. Stay tuned, folks. If you have questions or concerns or ideas that you want Kyle and I to talk about, hopefully we'll make this a reoccurring thing, and just put it in the comments below. Thank you.